For family offices, increasing allocations to alternatives also comes with more tedious tasks required to manage portfolios. Are these manual operational workflows slowing you down? This episode of the AYU Family Office podcast is brought to you by Canoe Intelligence. Born within a family office, Canoe uses AI and machine learning to automate manual workflows and transform how you manage your alternative investment data. Automate your document collection and data extraction process to turn tedious tasks into your strategic advantage, delivering precise outcomes and actionable insights to manage your alts smarter with Canoe. Over 200 family offices utilize Canoe to help improve efficiencies, scale their alts, portfolios, and future-proof the family office. Find out how in the podcast description or visit canoeintelligence.com/AYU.
Hello and welcome back to the Family Office podcast. I'm here as ever with my co-host, friend and collaborator, Lucy Sermon. Lucy, how's it going?
Yeah, hi Gus. Everything's been going good. We're here in sunny London. We've been hosting lots of different members' drinks and a couple of events throughout the summer, and it's been great. How about you? How's everything going on your side?
Yeah, lots of stuff going on, lots of development. We're looking at Switzerland for 2026 at the moment, which is really good. Planning some stuff, which is both family office and ski. Two things very close to my heart. So yeah, really excited about that. Stay tuned for more on that one. And today's cast was really interesting, wasn't it? Another family office professional, Julia Rees Toader, who's spoken on a few of our panels in the past, Family Office Summit in London last year, and recent AI and investment management panel, morning brunch we did in Mayfair, which is fascinating. That's a subject that's just going to keep on growing. Basically, we were only just touching the beginnings of AI, the application of AI in investment management. So that's really interesting. Julia's been around the block. She's been at Goldman. She's advised single family offices, most recently a big Italian group, and is now founder of PrinCap, which is a family office advisory. And she's a polymath, really. Like she's interesting to listen to on every front, isn't she?
Yeah, no, completely. I think, especially in regards to what she specializes in, which is portfolio construction, and understanding that insight and kind of hearing her perspective on working with these families and institutions that she works with. I think it's definitely a very educational and informative episode for sure.
Yeah, she's fascinating. There's quite a few times when she kind of throws out the rule book and really goes against the grain when it comes to portfolio construction. And she's definitely something I want advising me on my portfolio. It's impressive stuff. So yeah, without further ado, here is Julia Rees Toader, and I hope you enjoy. Okay, Julia, could you tell us your name and what you do and where you come from?
Absolutely. Thank you for having me on. I'm Julia Rees Toader, and I am the founding partner of PrinCap. We are an outsourced chief investment officer outfit. So what that means is we work with ultra high net worth families and sometimes institutions on building better portfolios. Sometimes they want to go deep on one asset class. Sometimes they want help with the entire thing. But often they just feel they want some other brain power applied to their portfolios outside of their just their small team.
Mm-hmm. And is always families, always single families, multifamily? What's the kind of shape of the client?
Always. So for now, always single families. And then I work with a couple of professional investors like private equity firms.
Okay, cool. And what level of sophistication are we talking about these single families? Because we are on a process now where families are becoming more sophisticated and either hiring in dedicated full-time staff, perhaps the halfway house, which is moving from the private bank to maybe outsource specialist insight, which is probably where you guys are. Where do you sit in that spectrum, and tell us a bit more about how that's evolving?
So actually, it's bifurcated. So some clients are extremely sophisticated and they understand that they are extremely deep on certain areas and they want someone to bolt on and supplement their intelligence in other areas. For example, families often have a certain market that they know really well. Maybe it's their market, the one that got them to family office status. So then I'm not going to add a lot of value there. But for everything else, they're not interested, but they know they have to solve it somehow. Then on the other side of the spectrum, you have families who want sort of a one-stop shop solution, someone to sit on top, on the same side of the table as them as they face with all of their banks and all their other providers.
I think just zooming back and understanding more about your background and how you got into this space would be super important to kind of get the context of how you ended up here.
Sure. Let me give you the genesis tale.
Yeah.
So I actually got the entrepreneurial bug all the way back when I was in high school. I started working at an early stage biotech company, and it was 8 people when I started, 80 when I left. I used to sign out of school to go to meetings with the CEO. It was really fun and interesting. We did M&A. I worked on accounting. It was an amazing entrepreneurial experience, and I saw the ups and the downs of an entrepreneurial lifestyle. Then I did computer science and engineering at Princeton and went right to Goldman Sachs afterwards. And I spent 12 years at Goldman. And I was very unusual there because I stayed in the same team and applied myself in the same way for the whole time. So what the business that we built was called portfolio strategy, and I was the head of portfolio strategy. In this role, I was advising the chief investment officers of sovereign wealth funds, pension plans, private banks, all different kinds of asset owners. What we found is that CIOs can sometimes get pretty lonely. They don't necessarily have huge teams. Even if it's, a big pension fund, you'd think, don't they have a ton of resources? Yes and no, and often no. And so sometimes CIOs would want to talk to me like this for 100 minutes straight, just about, tracking error in emerging market equities, something really fine, because they needed, a peer to go through with them. And I built out all kinds of proprietary systems and analysis tools to give that portfolio angle. So I've been a professional LP the whole time. So then I actually entered family office world a couple of years ago. I joined a multifamily office, mostly focusing on Italian families. And so there, it was an amazing experience working on the portfolios, working on the relationship side. And then I started PrinCap in January. And then what got me here, I'm a very passionate portfolio person, and I'm a classically trained portfolio builder. My Goldman granddaddy, if you will, was the founding father of modern portfolio theory. So I grew up in that doctrine of risk management, modern portfolio theory, and so on. And a lot of that is about diversification, wise risk management. And it works really well in an institutional context. Works really well for private banks. Doesn't work for wealthy people. I've been calling diversification de-worsification at this point. Because, I've analyzed in my career hundreds of billions of portfolios, dollars worth of portfolios, probably about 20,000 portfolios at this point, built by all different kinds of professionals. And most of them are too diversified for wealthy families, for family offices. Families did not get to become a family office by being too diversified. And on top of that, so it doesn't feel natural to them. They apply themselves intensely for a couple generations, have their liquidity event, and then they feel detached from their wealth because it's a hyper-balanced portfolio that doesn't look anything like stuff that they know. And what's going on here is that oftentimes the professional on the other side of the table from the family isn't able to have a really intense risk conversation with them. Risk has to be felt in the belly, and you can't go to a family, an amazing engineer, let's say, and say, oh, Miss Lucy, you have 7.8% standard deviation. It doesn't resonate with you, right? You don't really know what that means. So I've put in a ton of effort into making risk a lot more easy to understand and making sure that we can understand how it'll affect our behavior. Because if you don't have a good risk conversation, the portfolio you build is going to be too conservative. It's going to have 100 line items. It's going to be mostly cash and fixed income. Whereas when we build portfolios, we're making the most of the risk budget that the family can truly stomach.
Well, is that, the gap that I can really see there is the I guess kind of the frustration that a family office might have with a private bank who's only selling something off the shelf and is kind of separating. There's not divorcing, but there is a significant moat to cross in understanding the risk that the bank is selling and what the family office is willing to take. And those two things are often completely mismatched.
Yes. What I've found from looking at thousands of portfolios built by private banks, portfolios built by families, you have to somehow cross that gap, right? And typically a portfolio that has, it's the balanced multi-asset portfolio and it has all these funds underneath it. It's typically not the right fit for a family. They want to express themselves more. They want to often be taking more risk. Oftentimes a portfolio is designed to give you mid-single digit returns, and families are used to doing better. You often see, I also have noticed this divide where European families are sometimes earning only about 1 or 2% net of taxes and fees and inflation, whereas Americans are doing a bit better. And then on top of that, families are, of course, going to read the paper and see headline inflation, but they're not exposed to headline inflation. They're exposed to luxury inflation, which is normally twice as high. Think about the price of properties and other kinds of luxuries. So you actually have to plan. If you're the professional advising a family, you need to plan on outpacing luxury inflation.
How do you go about, I guess, changing attitudes to risk with some of these family offices when you're going in, the portfolio constructions and these alien topics that, they're like risk averse about? How do you go about demystifying that or making that appealing to family offices?
So often what I do is I try to phrase things in terms of potential losses. It's mathematically equivalent to say you have XYZ standard deviation, which is what you're going to find in every PDF that you get from the banks. It's equivalent to say in 99% of bad years, you'd be doing worse than this percent loss. You can kind of reframe it from a wild, 7.8% standard deviation. What does that mean? Into a potential loss, a drawdown that you can understand. And then you can sit and stare people in the eyes and make sure that they're comfortable with the idea of losing, let's say, 20% of their portfolio value. And if they're wiggling, it's a portfolio that's too aggressive. Because the last thing you want is for the family to be asking to sell the assets right when they're down.
Again, can we use this phrase zooming out a lot because we're trying to get a holistic picture of family offices are constantly moving target.
Oh yeah.
One of the things that we struggle with all the time, and we've had to draw our own line in the sand, is what is a family office? What defines it? So that's the question. What defines it to you? Is it size, sophistication, investment? Do you have something that you kind of hang your hat on there, or is it constantly moving target stuff?
I think it's about size. I think if I had to pick a line, I'd probably say 100 million would be the line for having a family office. The folks who are in that $20 to $50 million range are still often private bank type clients.
We've been back and forth on it, and we set our line at 50 because quite a few people. The argument is that it could be 50, it could be 250, it could be 500. It really, I can think it kicks in when you have enough to actually start employing people to, whether directly or indirectly, to service your needs specifically, rather than buying something off the shelf, which is private bank territory, really. Obviously, they'll bespoke things for all their clients there, and there is a very, very solid place for those private banks.
Oh,
but it does make sense in that bracket, yeah.
Yeah, and those families will have many private banking relationships, but then that causes an exponential increase in complexity that they don't want to deal with. So it's often helpful to have someone just right on your side of the table, helping you map all your relationships and make sure that you're getting the best out of every bank. They all have different strengths. And
then after that, I mean, I guess your basis of clients, I'm going to guess there's a wide spectrum from 100 up to, crazy levels.
Yes,
exactly. That'll be fair. Crazy levels.
Exactly. I call it ultra high net worth.
Yeah, ultra.
Yes.
And so where you're sitting right now, granted it's July 2025, what trends are you seeing right now in terms of, what are you seeing in terms of from family offices in regards to portfolio construction?
I think families are feeling a bit bipolar about AI right now. On one hand, they know they want to do it. They know they want to invest in that theme. But then there's also a sense of fear because it's, have I missed the boat already? If I start learning now, will I ever catch up? Maybe I should focus on the next big wave. So right now, lots of questions inbound about how to invest in AI.
Are you saying that because it can inform so much, it has the potential to inform so much else in portfolio construction?
Well, yes and no. I mean, if some families feel like, Actually, I know somebody who had a chance to invest in the seed round of OpenAI and passed on it because he didn't understand it. And he's like, can't win them all, right? So there's this sense of, if I start investing in AI now, is it too late? But then they also want to do it. So I've been helping folks figure out what themes do you want to be aligned with and how to get the right exposure. Because, some of these AI investments are obviously not going to work. So we're trying to pick the right funds, usually, sometimes making direct investments, but mostly relying on finding the best fund managers who are so deep in the space.
Uh-huh. And how does that fit in with, say, more traditional portfolio construction of the vanilla package, the alts that come into that, probably their specifications, and often real estate or it could be into their specialization, which could be real estate or any number of things we see in our membership base. Where does that fit in with traditional construction?
I'm actually not doing traditional portfolio construction anymore.
Interesting.
I'm not doing, here's my buckets, every investment has to go in a certain bucket. I'm not doing it anymore. I don't think it applies in family office space. And actually, one of the advantages of being a family is that you don't have those asset allocation buckets. For example, let's rewind a couple of years to when we had that big equity sell-off. The institutions all have strict so-called investment policy statements. So this is the rules by which the CIO has to abide. They can only have between 10 and 12% private equity, for example. So when public markets go down, private markets aren't marking to market, so they look high. So all of a sudden you had these sophisticated institutional CIOs overweight private markets and forced to sell their positions in funds that they really liked. They were forced to sell not because these funds were bad, not because they didn't like them, but because of their strict investment policy statements. In enter the families. Families don't have these strict rules. They're not held by those specific chains, right? So in 2022, 2023, families were able to buy those LP stakes in private market funds from institutions at a big discount. And hey, the providers of liquidity always get paid. That's something that I've seen to be true about the markets. So this is a chance where by being a family, you can be earlier, you can be a little bit more nimble because you don't have the same predictable constraints as an institution. Also, some institutions will have a program for emerging managers or small managers, but most don't. Most of the time, the manager has to be a certain size before they can even make it past the consultant, which is employed by the institution. Mm-hmm. Whereas as a family, we can go in and be in the first fund, for example, of a promising new manager and, command better economics for it.
So that kind of thing is music to the ears of lots of managers, aspiring managers and emerging managers. And I guess also larger managers alike, but that emerging space, there is always fresh talent coming through looking for that capital.
Yeah.
And that's the hardest, having sat in that seat myself, that's the hardest bit of saying, okay, well, we have a fantastic CIO, we have a fantastic PM, we have a fantastic alpha proposition, but getting that to market is very, very difficult.
Very difficult.
So having someone who, if you're pitching to a family office, often it's going to get lost. So if they can pitch to you who's been back and forth on fund offerings over and over again, that is insanely valuable, basically. So you need to almost be careful with your time there because you're going to get inundated, right?
Yeah, no, and we do. But sometimes we do, because we know that we're providing this important liquidity at the early stage, we're able to, write an LP ticket and also take a position in the GP. You can't really have that conversation with Blackstone.
No.
They're too big. Well, they're too big, right? But with an early manager, for a strategic investor, you can often strike some pretty interesting deals.
Can you just give me a very brief characterization of appetite across hedge, private equity, VC, real estate? Now, credit you can chuck in there too, crypto you can chuck in there too.
Yeah.
I'm saying alts, but the big guys, the big ones. And what's the balance like in family office world right now?
Yep. Interestingly, hedge funds are back. For years, hedge funds were trailing the most basic of betas, and it was extremely hard to get excited about them. As a portfolio construction person, I really appreciate how, a hedge fund can improve the Sharpe ratio of your portfolio, reduce the risk. I mean, I get it, but I wasn't able to do it, But these days, it feels like the environment is much more accretive for hedge funds. The carry trade is back, interest rates are higher, dispersions are wider, there's interesting fund launches. So we are doing quite a lot in hedge funds. But it's not because we have the asset allocation bucket says I need to have 6%. It's because we are doing returns ranking. We are investing according to where we think the returns are going to be. We're looking for deep alpha, and then everything else is going to be inexpensive beta. So I'm really doing a barbell type portfolio. And so in hedge funds, this is where you find a lot of the alpha talent. So I'm going there. And also in the private markets. I view the private markets as really the playground for alpha generation. It's a fertile ground for alpha, right? You can earn a significant premium for dealing with complexity, for dealing with a lack of information, for dealing with interesting structures. And again, because there's less money available, right? So you can get a premium for giving liquidity. So in terms of across those asset classes you laid out, seeing renewed interest in hedge funds. And if you look at some of the raises that were going on, you even see hedge funds acting more like private equity firms. They're realizing, oh, PE is a better business. I'm going to have a lockup. I'm going to have a drawdown structure. Seeing a lot of action in the hedge fund space and really successful fundraising and a lot of interest from families, mostly on the big, brand name side. And then private equity, tricky right now. I actually think we're in this stage of peak frustration with the private markets and with private equity. A lot of families feel like managers didn't really tell them how long things were going to take. I had a family complain to me about getting an 8-figure check in the mail because it was from a private equity fund he did in 2010. So it's way past, it should have been done by now. It was a first world problem. Yeah, but, just to illustrate the point, things were taking a lot longer than he expected. And there's this also, you make a commitment in private equity, and then you're excited, and then only a small amount of capital gets drawn. Yes. So there's a bit of an emotional letdown period.
So is the kind of renewed interest in hedge funds a symptom of that, because they're a much more liquid instrument? You can get in, get out. You can actually see something visceral.
Yes, I think so. But people don't hold hedge funds and private equity in the same bucket mentally. I think it's more about the resurgence of alpha or interest in finding outperformance and in finding great pockets of the market. So you have a question on the tip of your
Yeah, absolutely. So in between those two, and this is something that's coming up a lot more recently with our family office conversations, is private credit.
Yeah.
And how that fits in. So we survey all our family offices who come to events and become members, and it for us is the leading appetite across all of them, and over the past 2 quarters, essentially. Does that ring true? Is that sitting next to this resurgence in hedge funds, because it's there's liquidity there. It has a different shape. In the underlying, but it's performs very similarly.
Yeah, and it's almost a private equity proxy because the companies are private equity backed. Yes. So right now, the returns in private credit are rivaling those in the bulge, or even exceeding those in sort of bulge bracket private equity, mega cap private equity, let's call it. So of course, investors who have this preference for taking less risk, they want to see more income, it checks out. However, the bee in my bonnet is I don't think that private credit should be in a drawdown vehicle, a private equity style vehicle, because most private credit books, a third of the book will turn over every year. Private credit is an expensive form of debt for companies, and so they want to pay it back. So typically you have to, you have a third redeeming every year. So I believe that, when we do private credit, we should do it in more of a semi-liquid or even an evergreen structure. That makes more sense to me as an LP. I don't think you should demand from me all that illiquidity, because your asset class has liquidity, roughly a third a year plus all the juicy coupons. So that's sort of the angle I'm taking.
Okay, so this is really interesting. We're going through the silos here.
Yeah.
Talk to me about VC, talk to me about real estate funds.
Yeah.
And talk to me about crypto funds.
Okay. So VC, I really like the space. When people are running away and scared of stuff, that's when I like to run at it. I think that's when you can really earn an outsized return. Same with, crypto and crypto winter. You have to maintain your interest even when the beta is against you. So that's when you can position for then a subsequent rally. And families often have a very long investment horizon. So of course they want to be invested in VC. It is a spicy part of the market. It's tough when you have to expect, if you look at a fund, you might expect 40% of their investments to go to zero. That's an unsettling feeling if you're used to public markets or even private equity. But we're absolutely doing venture capital. We're doing it mostly via funds and then occasionally doing, direct investments or co-invests on top. But yeah, I think the interest is really there and it's kind of spreading out. It used to be Silicon Valley or nothing. Now, there's lots of compelling funds in New York, and it could be an amazing era for European VC. Because there's a sense that you can build a business here that is durable, but for less money versus in the US. And there's great talent in Europe. So I'm actually watching the European venture scene really closely. So I think this could be a great era for it.
Yeah, it's being talked down a lot at the moment, how the American work ethic and the funding and everything. There's still plenty of good stuff in Europe, right?
Yeah. But we're still doing, 80% US. Sorry.
Well, this is what I wanted to know, and whether this is what you're doing or broader strokes. We've talked about the different types of strategies. Now, let's place that geographically, in the US right now, there's a lot of geopolitical stuff going on. Actually, a lot in the world in general, let's be honest.
Yeah.
But how does that sort of look? A family office is looking outside of the US now. Is Europe being more appealing? Is the US still, superpower and people are looking towards it? What about emerging markets? How does that all place in terms of, the world?
Right. So political risk, geopolitical risk, it's always there.
Yeah.
And throughout my whole career, I found you can't really trade on this stuff. And it's better to maintain a cooler head and sort of a more long-term view. And frankly, families usually have a very long-term investment horizon. Sometimes, contractually, they're not going to touch the money. It goes to the grandkids, right? So I find that these political things, it's good to be aware and to be able to answer questions and talk about how it affects the portfolio. But we're not actually trading around the geopolitical risk. Like during Brexit, for example, I remember getting to the office at 5 a.m., looking around the floor, what is going to happen today? We didn't actually have to change the portfolios because they were already well diversified and not overweight UK. Honestly, the issue is many European families are accidentally, unintentionally overweight their home market. So, for example, you talk to an Italian family or an Italian private bank, and, most of their fixed income, all of it is Italian government bonds.
Just an unconscious bias.
Yeah. But then you go to the UK and you would never have a private bank recommending that you have 100% of your fixed income in Italian government bonds.
Just wouldn't, yeah.
No, certo, no. It wouldn't happen, right? So this also happens, of course, in the US, but the US is a huge part of the global market, so the bias isn't as damaging. Whereas if we take, here we're sitting in London, if you're overweight UK equities, you don't own enough technology. What's available on the UK stock market is mostly, consumer staples, oil. There's not tech here. You have to diversify globally or you miss out on a world of opportunity. So I'm really firm about our starting point should be global, not overly biased towards the home market. And you have to be so careful because it's easier to sell stuff that has a home country bias because then there's some familiar names in there. So even if a product is called the Global Income Fund, Global Multi-Asset Fund, it probably has a baked-in home country bias that might end up being the biggest alpha trade in your portfolio. So I'm always watching for that.
Interesting. How does that compare to direct equity markets and direct deals? I mean, you mentioned, and I want to kind of go further deeper into the co-investment and following some of the VC investments, because that's really interesting.
Yeah.
When you're looking at directs, are you looking global? Is there a bias to here, to America, to continental Europe? What's the process then?
No bias. So you're talking about doing private equity on hard mode by yourself. That's what direct investing is, right? It requires much more of you on the due diligence side, or it requires a different skill set versus manager selection. So, as a family, we're always receiving solicitations, right? You're an absolute magnet for pitches. And on one hand, it's great because now I have a ton of pitches that I can, so I have my own internal benchmarks. I know something good when I see it. But I'd say, direct investment is the sexiest, but also the hardest thing. Many families will actually be catalyzed to seek professional advice after they make a direct investment and it goes south. It's my college roommate's kid and their company. It sounds great. And then it doesn't work out. So that's where you really need the portfolio effect. And often a couple experiences like that will catalyze a family to go get more professional advice.
Yeah.
I've seen it so many times. And you have a great entrepreneur, they exit, it takes them, 2 years to get used to the feeling. Then they start doing some investing, couple winners, couple losers, and they think, okay, I'll add on some more approaches. So when we're looking, it has to be something really interesting and it has to be in a space we know. Otherwise, what right do we have to win, really?
What is your sort of, I guess, and I appreciate this is a loaded question, so you can keep it high level. But what is your sort of process for analysing a good deal or fund that would pique your interest? What are the sort of first ticks that you'd be like, okay, this is something that I...
Can I add just a precursor to that as
Yeah.
you answer it? Is the point where you actually, the discovery of the opportunity, whether it's coming from a VC, or it's coming from another family office, or it's coming in cold, from that to what Lucy said is a really interesting journey.
If your portfolio is all inbound stuff, you have a problem. And it's very easy to build a portfolio out of all inbounds. People know that family offices, or I should say, a lot of people expect that family offices have a lower threshold for operational due diligence, a lower threshold. I mean, I had a VC fund try to pitch me, and the moment I engaged counsel and asked for a data room, disappeared. But there's
Big red flag.
right. I thought that would happen, so that's how I get the pushback, right?
Yeah.
But it was, but he managed to raise like $50 million from other families without a data room,
Wow.
just with a pitch deck.
Ooh.
And, I think he's going to hustle and maybe he'll get there. But, as a professional, I can't do it, right?
Yeah.
No, can't do it. Yeah. So what I've learned is you should have a mix of inbound ideas, but also outbound. Oftentimes the best GPs, there's a line. So you have to really, I often find myself pitching us as a strategic partner, as a great LP who's going to be helpful in other ways. You have to sort of position to get for them to do you the honor of managing your money because they have,
GP
excess supply. Yes, exactly. So that's the first thing. I always look for a mix of inbound and outbound. And then I'm not really seeking to fill different asset allocation buckets, not anymore. It's more about I'm looking for outsized investment returns. So looking for folks with interesting niches, with the ability to generate alpha, because I'm going to have plenty of other investments that are giving me market beta, just market exposure. Great. It's globally diversified. I'm not going to miss anything major, but I want to be bolting on that uncorrelated excess return, right? So I'm looking for often niche sorts of things. Like right now, doing a lot of litigation finance. This is an interesting space, right? Because it's hot on family office scene because a lot of institutions don't have a bucket for litigation finance. So these GPs have to raise the families first.
I think I'd be curious to know, what industries themselves excite you? We spoke about AI. You had you speak on a panel recently about that. What other sort of, I guess, industries within from the VC fund side of things or PE or what sort of industries essentially excite you right now?
Honestly, I don't really think thematically like that.
Okay, let's get to that.
So plenty of people do. My fear is that if you think thematically, like I want to own AI, I want to own healthcare, I want to own aging demographics, there's a lot of themes that are very easy to sell, frankly. Easy to talk about, they resonate.
Yeah.
Makes sense. But the underlying exposure in those tends to be similar. Like it's all growth, for example. And so I actually don't think that way. But what's exciting me is managers who are in these weird niches, like or taking a different approach. So, for example, looking at in the venture space, we're looking at venture studios where the exited entrepreneurs in the studio come up with the ideas and they hire a CEO to bring it to life. It's like sort of a different economic trade, and it complements well what we're doing in other places. Or we're even looking at buying out entire solo GP funds in the VC space. Because, there's plenty of people who got into VC during the ecstasy of 2021 and then realized they didn't want a 15 or 20-year commitment, but they have a couple of good names. So I'm super interested in secondaries as well. That's been a big...
Yeah, this market, especially in the family office space, both who are looking to get into something they missed and also looking to get out of something because they need liquidity, but their money is tied up for a bit. This is going to be a really interesting space.
Yeah. I mean, how often do you get a time machine? This is it. It's fantastic. Yeah. And so I'm always screening that. And like right now, doing a couple direct secondaries in big private companies. It's fun. And it's also... these are stocks we want to own, but you have to be creative in how you get that exposure.
Yeah, we actually have the founder of a secondary VC fund on our cap table, which is really interesting to see the advice that he's giving us. The insight on that market is really, really powerful. So yeah, I'm excited about that. There's lots to come.
I mean, secondaries in buyout funds, that's a space that's now much better understood by the family office community, to the point where, I'm even doing equal amounts of secondaries in buyouts as I am primary commitments.
Really?
Yeah.
Okay.
I like.
I want to drill down into something specific there in secondaries. Tokenization.
Yep.
Just straight opinion. What do you think?
Okay, I'm a fan. Yes. I actually almost quit my Goldman job to be a crypto hedge fund manager when I was on maternity leave. Fun times. The timing would have been so bad if I had done that. But I've been following the space ever since, and I think tokenization is fascinating. Again, because it's a liquidity mechanism. It's going to make certain things possible, right? And so I'm actually, I love the thesis, and I'm partnering up with the leader of tokenization here in London to launch a fund where we're going to do private market special situations and then tokenize.
Interesting.
So interesting, real world assets that have the economic rationale and the high returns. And we're going to make it available kind of classic version and also tokenized version.
Yeah, I think that's the way it's going. To my mind, everything will be tokenized at some point in the future. And speaking to that secondaries opportunity, that's a vehicle which just makes everything so much easier to access in a very, very structured, nice, easy, clear way. I mean, that's just fascinating. We've been going around the world this year with our partners at Jersey Finance, hosting an event every month every quarter, in New York, Miami, Geneva, Zurich, and London, talking about RWA tokenization to start with, because it's understandable. But when you start to tokenize funds of every stripe, we're going to, the shape of the market is going to change drastically. So really excited about that.
I'm excited. Like right now, trying to get exposure to these late stage growth private companies. The secondary market now, it's like the Wild West. You have one company and you get wildly different valuation offers, 3 and 30 carry structures on some. You have a lot of...
You have to be in that pasture in the Wild West to know that it's happening as well.
Yeah.
It's not like you've got a clarity and a view across the whole of the Midwest.
Exactly.
It's the West, is it? So
when those are tokenized, we'll have more clarity, which will be helpful.
That's really interesting. I want to get into that a lot more. How do you feel about cryptocurrency in general now? We're kind of on that space. I'm talking about the wider market, but then also crypto funds specifically, because we have been hosting crypto brunch and crypto events since 2018, and every single event there is always the when's it going to happen conversation, the institutionalization conversation. We felt that family offices were going to be the first at the table to really get crypto funds over the line, over the classic AUM lines, to get emerging managers going. That is happening, but it's happening a lot slower than anyone imagined. The big institutional checks are starting to green shoot, and there's a few here and there, but it's not an everyday thing now.
Yeah.
Where do you think the crypto fund industry is specifically for that? Sorry, very long question, but it's something that comes up so often.
Well, hand over heart, I think crypto is a great place to be looking for alpha. When you learn all the classic alpha generating techniques that you apply in the public markets or in fixed income, doing those same things in crypto works even better. For example, I had a strategy in crypto where I was using some of my classic portfolio construction techniques, but applying them to baskets of cryptos versus baskets of, regular equities. And it works. It works better because it's a more inefficient market. So I think crypto funds are probably going to be the way that people tap into it, almost like a hedge fund mindset. So they'll be, I view crypto as part of the hedge fund bucket because you're really trusting somebody else's investment skill, but you're giving them a very fertile ground in which to hunt for alpha because there is so much movement, so much lack of transparency. All of that is stuff that is good for alpha. So overall, I think it's interesting, but we're still in the very early innings and people lost so much money.
Yes.
In, 2022, people lost so much money in crypto and they're burnt.
The media doesn't also help with that narrative either.
No, I mean, do you remember that market?
Yes. I think we were in New York.
We were sitting on the panel in New York when
New York.
when it went down, and
Yep.
you could see it going around the room in real time. It was crazy.
Yep. I remember that day. Yeah.
So you're saying there that crypto funds should hold fast.
Yeah. I think that
Keep going.
it's going to happen.
Yeah.
But I think people just lost so much money and they're still mad. And you can't get back in now. I mean, like the sense is if I'm not back in, I've already missed this run up.
Yes.
And you're not
Wait
getting
for the
back
next
into Bitcoin or ETH. You're getting into managers who are specifically looking for the alpha in a basket.
That's what I would do.
Yeah, but-
I mean, if you talk to other people, they really believe in, Bitcoin is digital gold, things like that. Sure, if you were early in it, I would keep it. But it's not really something that I cover closely.
Do you just in that one there that there's a structural shift which seems to be appearing in that there's potential roll-ups of a number of different crypto managers who have started and run out of runway because they didn't think it was going to take so long to get to an AUM level which can sustain the fund. So there's an opportunity. We see multi-managers coming to the fore quite significantly. Do you think that's going to continue? Or we're going to still see a further proliferation of individual managers?
Yes. So fund of funds are tricky, right? Because on one hand, fund of funds sounds expensive, fees on fees, but also it takes the downside edge off. And given how volatile the space is, given how people have been burnt, I do think a fund of funds approach will probably resonate with investors when they're first dipping their toe.
Mm-hmm.
Yeah.
It's like 2001 again, right? It's the easiest way to navigate, basically, and for good reason. It disappeared because we didn't need fund of funds as much anymore because you had the experts on the boards, especially in pension funds.
Mm-hmm. Exactly. Yeah, and you might I see it all the time when you go into a new asset class. You just do a fund of funds first. Do something where you're not going to be hugely wrong or hugely right. And as you become more expert, then you try to be right more often than you're wrong.
Gosh, Fab, you have so much insights, and I'm aware that we are running out of time.
Yeah, I could talk about this forever. I'm going to get you on again.
Think your portfolios. Yeah, I think a great way to kind of wrap this up would be like, what are you looking forward to the most across the rest of this year, professionally and personally? What does that look like for you, Julia?
Ooh, well, I'm really jazzed for the year. I'm doing a partnership, as I mentioned, with a tokenization leader here in London, and we're doing this real world asset fund. And what that's all about is high investment performance, trying to provide really the antidote to LPs' concerns right now in the private markets. That it's taken too long, that it's not very emotionally satisfying, at least for the first 10 years, that the returns are going to have to come down because the market is getting saturated. We're trying to be the antidote to that. And I love the investment content of this product. So that's why I'm doing the partnership. And then, running that fund. And then secondly, I'm right now, based in London, really enjoying the access here. But I'm doing a partnership with a New York investment bank to go more global. Amazing. And have a big couple months, I think. Well, fingers crossed.
Okay, and then I guess a much bigger question. Where is the family office industry, for want of a better word, going?
Yes.
It's not going anywhere. Yeah. I think the space is going to continue to attract talent. And you're going to get great investors coming in. And we already had that dynamic. For example, there's an amazing arc of hedge fund and private equity managers where they run other people's money and then just turn it into a family office. So I think we're going to see more of that crossover, like family offices becoming asset managers, family offices becoming multifamily offices, right? More of that. And I just think we'll continue to get more professional, but I really don't want family offices to lose that extra flexibility. But if becoming more flexible, you kind of suck the joy out of it. I've seen that happen. That's not it. Like,
Dynamism is exciting and it's a fun place to work. You really get to be the stuff you're talking about. You really get to to be yourself and apply stuff rather than, you said yourself, you don't have specific allocation buckets and rules to stick with. You can be much more, opportunistic and really dynamic. And every single one is different. So that for me is the exciting part of this.
Exactly. Like I have one family I work with where, she wasn't even enjoying her wealth. She felt like it was a totally separate thing, didn't look like her, didn't represent her values at all. So now we're bringing the fun and the impact back into the portfolio. And she's been able to attract even more money and that flows through her into her areas of interest and into her passions. Like she's really into families and children, so we're investing in that direction. It's been really fun to get people's portfolios aligned with their, with what they care about.
Yeah.
Well, more for that. Let's keep going.
That's what you want to talk about.
Julia, we've got loads more to talk about. We'll get you on again. You're on a panel this morning with us here in Mayfair. Hopefully going to get you back on a panel at the London Family Office Summit in October this year.
I'd love to.
Returning for a second year, and then hopefully in Switzerland in Q1 next year. We'll be back in the mountains.
Perfect.
So yeah, thank you so much for coming, and we've loved having you.
Thank you, Julia. It's been great.
Thank you.
Okay, well, that's fantastic to sit down with Julia again, wasn't it, Liz?
Yeah, it was absolutely fabulous. I mean, that woman is a powerhouse. And, if anyone's going to talk about portfolio construction, I want to be listening to her, that's for sure.
Yeah, so we'll get her back on. I didn't think we, as with all our guests, we didn't really get round all the houses, did we? Loads more to talk about with her, and we'll definitely be having her on more panels, and it's great to have her on board. So thank you very much, Julia.
Yes, thank you, Julia, and for everyone listening, we'll see you next time.
For family offices, increasing allocations to alternatives also comes with more tedious tasks required to manage portfolios. Are these manual operational workflows slowing you down? This episode of the AYU Family Office podcast is brought to you by Canoe Intelligence. Born within a family office, Canoe uses AI and machine learning to automate manual workflows and transform how you manage your alternative investment data. Automate your document collection and data extraction process to turn tedious tasks into your strategic advantage, delivering precise outcomes and actionable insights to manage your alts smarter with Canoe. Over 200 family offices utilize Canoe to help improve efficiencies, scale their alts, portfolios, and future-proof the family office. Find out how in the podcast description or visit canoeintelligence.com/AYU.